Hello everyone, welcome to the Stock Trading Tutor channel. In this video, we'll be seeing how to use a moving average to buy stocks. So while we are looking at this article and learning the technical parts of this strategy, we'll also be applying this on the chart at in live charts. Well, okay, maybe not live charts, but we'll be seeing how the signals will appear in the charts using the AntWeb software of Alice Blue. So let's look at what is moving average. So moving average is a simple technical analysis tool that smooths out the price data by creating a constantly updated average price. So this average is taken over a specific period of time, like 10 days, 20 minutes, 30 weeks, or any time period as the trader chooses. So there are advantages to this as well as disadvantages. So let's look at some of the options. So before that, why should you use a moving average? So a moving average helps cut down the amount of noise on a price chart. So you can look at the direction of the price movement without getting distracted by the sudden jerky volatility of the market. A moving average can also act as a support or a resistance in an uptrend. A 50-day, 100-day, or 200-day moving average may act as a support level or as a resistance level if the stock is in a downtrend. So let's give you an example. So here we have the AntWeb, and we have expanded this chart here. This is the HDFC stock candlestick chart. So let's apply the moving average to this. We'll go to the studies part, and here, as you can see, we have lots of indicators. We will select the moving average. So we can specify the number of periods we want to use. So since this is the average of the certain number of periods, the moving average, let's see how the 5 period moving chart will look to start with. And this red line here, as you can see in the background, is the moving average indicator. So this extra red line is the moving average line. So as you can see, with the 5 period moving average indicator, that is or known as the 5-day simple moving average, it follows the candlestick chart very closely. Now let's edit that. So let's apply 20-day simple moving average. So as you can see, it doesn't follow the trend as closely as the 5-day simple moving average. So let's edit this some more and keep the 50-day moving average. As you can see here, this just shows you the overall trend of the chart, but it doesn't actually go high with the highs or as low as the lows. You can zoom in and zoom out with the moving average to see how it has performed over the years. So this is completely customizable, so you can select your candlestick chart based on the time frame you decide. So here we have the 15 minutes moving chart now, the candlestick chart for simplicity. Now let's look at some more. So a moving average can also act as a support or resistance. In an uptrend, a 50-day, 100-day, or a 200-day moving average may act as a support level. So here we have an example given here. So since the stock is in an uptrend, the moving average is acting like a support line here. So since this is the average, it acts like a floor or a support. So the price just bounces off of it. In a downtrend, the moving average may act as a resistance like a ceiling. The price hits the level and then starts to drop again. So this is not always true. Sometimes the moving average will act as a support level or resistance level, but sometimes the market can be volatile and unpredictable as well. So let's look at some different types of moving average. So a 5-day simple moving average, as we have already seen, adds up the 5 most recent daily closing prices and divides it by 5 to create a new average each day, or basically each period. So each average is connected to the next and creates the singular flowing line. So this specific point here, as you can see, is an average of the last 50 periods. Since this is the 50 period moving average. The last 50 periods average is right here. So another popular type of moving average is the exponential moving average. So this is slightly more complex. So if you plot a simple 50-day simple moving average and a 50-day exponential moving average on the same chart, you'll notice that the exponential moving average reacts more quickly to price changes than the SMA due to additional weighting on the recent price data. So let's apply this onto the chart here. Let's add another moving average. Here, let's change the type to exponential moving average and change the color so that it is identifiable. Let's keep this blue and done. So as you can see, the blue line moves much more closer to the price candlestick chart than the simple moving average, which is the red line. The exponential moving average line is more following the candlestick pattern more closely and reacts more quickly to the trend changes. So since we use charting software and trading platforms, we don't actually have to do the math or know the exact calculations or the equations for this exponential moving average or the simple moving average. So now both of them are pretty much equal. So one type of moving average isn't better than the other. An exponential moving average may work better in a stock or a financial market at a specific time, and in other times, a simple moving average may work better. So it depends on the time frame chosen for the moving average. So this will play a significant role. So let's look at what type of moving average length you can use. So the most common ones are 10-day moving average, 20, 50, 100, and 200. So you can apply these to any chart time frame. So 1 minute chart, daily chart, weekly chart, and so on, depending on the trader's preference. So a moving average with a shorter time frame will react much quicker to price changes than the moving average with a long look back period, as I've already shown the difference with the 5-day period and the 200-day period. Let me show you again. Let's keep this simple and keep see. So this blue line is the 200-day moving average in this chart, and the red line is the 50-day moving average. As you can see, the red line keeps up with the candlestick chart a lot closer than the 200-day moving average. The 200-day moving average is pretty much vaguely keeps up with the trend, but shows you if it's in an upward trend or a downward trend. It doesn't take into account the market volatility as much. So let's look at some strategies. So first is the crossover moving average strategies. So this is the first type of price crossover. So when the price crosses above or below a moving average to signal a potential change in the trend. So as we can see in this example here itself, when the candlestick chart goes below the moving average line, this is a sell signal. And when the candlestick chart goes above the moving average line, this is a buy signal. This is a buy signal here, and again when it goes down, this is a sell signal. So here in this example itself, you can see this is basically a $5 difference in this example chart. So let's apply this to the chart. Let's remove the 50-day moving average chart, and this is just the 200-day chart. So when it crosses above, this is the buy signal and this is the sell signal. So here, as we can see, let's go closer. Here is the buy signal. The chart moves above. From here, it's going up. It's in an upward trend and it goes down here in the downward trend. However, the market is a little volatile and it's lying flat right now. Here again, we can see this is an excellent example of the chart. So this is a nice buying signal. The candlestick chart just goes above the moving average line. This is the 200-day moving average line. And here we can see the candlestick chart going below. So this is the sell signal. So this is the price where this is close to 2300 level price, and here is 2400 level. Now this is obviously not as easy to detect, so we can still use this one here. Here it's a small lot less smaller amount difference, but you can see this has helped. So here is the buy signal and here is the sell signal. These are pretty close. Next, let's look at the next strategy. So another strategy is to apply two moving averages to a chart, one longer and one shorter. When the shorter moving average crosses above the longer moving average, it's a buy signal, as it indicates that the trend is shifting up, and this is known as golden cross. When the shorter term moving average crosses below the long term moving average, it's a sell signal. And this signal is indicated, this is called the death cross. So this we have here is the 200-day moving average. Let's apply a 50-day moving average on top of this. Yes. So when it crosses here, as we can see here, so the red line here indicates the 50-day moving average, and the blue line is the longer look back period, that is 200-day moving average. So this specific point here is a buy signal. And here we have the sell signal here, right here. Here again is a sell signal, and here is the buy signal. This is a lot closer and you can tell. So these are the chart trends. However, please keep in mind that the market might be volatile, so you'll have to keep this properly. Again, this specific time frame, here was the buy signal and here was the sell signal. So that's how moving average work, and these are the two most common strategies to be applied using the moving average. You can also use other moving average to add on as a supportive to give a better signaling strategy. So now let's look at some of the disadvantages of moving averages. So moving averages are calculated based on historical data. So nothing about the calculation is predictive. So the results using the moving average can be random. At times, the market seems to respect the moving average support or resistance and trend signals. At other times, it shows these indicators no respect. So, one major problem is that if the price action is choppy, so that is, if the market is very volatile and the stock goes up and down rapidly, so the price may swing back and forth, generating multiple trend reversal or trade signals. When this occurs, it's best to step aside or utilize another indicator to help clarify the trend. So, as we see here, this was the buy strategy and this was the selling strategy, but the price was very low here and this would have led to a specific loss. So, when it looks like that, you can use another indicator on top of this using these studies, something to help support and make you understand the trend a lot better. And you can use that to determine to give you better signals or clarify the trend. So you can even adjust the time frame to give you a better idea. Mm, let's use the time frame. So this is the daily chart, and again, so this was the sell signal, this was the buy signal, and it's still going in an upward trend according to this. So in when it's like this and the signals are a little confusing, you can apply other indicators to support your trend identification. So let's look at the overall. The moving average simplifies the price data by smoothing it out and creating one flowing line. So this makes seeing the trend easier. Exponential moving averages react quicker to price changes than simple moving averages. In some cases, this may be good, and in others, it may cause false signals. So, moving averages with shorter look back period will also respond quicker to price changes than an average with a longer look back period. So, moving average crossovers are a popular strategy for both entries and exits. So, investing using moving average or any technique requires investment account with a stockbroker. So, you can create your Demat account with Alice Blue, and the link will be given in the description. With Alice Blue's brokering service, you'll get excellent exposures and margins for trading in the market. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel.